Hi everyone. Welcome again. Today we have a very interesting guest with us. Although we had a couple of audio sessions with Kedar, but this is a video format for the first time. So let me take this opportunity to introduce Kedar with you. So Kedar B is a founder and investment manager at Congruence Advisors. His venture, which he started in the year 2019. Starting in his career, he started his career in IT software at Infosys and later gradually moved to roles related to the financial markets. And it is his passion which made him come full time into financial markets. So he had in the past he had looked after institutional sales at wealth advisors. He has also worked as an investment specialist at ICCI Bank, and those who are on Value Picker very well know he's a collaborator and used to share very valuable information related to the financial markets. And as far as his education is concerned, he's an engineer, and mostly what we do after engineering is an MBA. So he's an MBA also, and owing to his interest for the financial market, the natural progression to full-time investment manager. And he firmly believes investing is something which is merit-driven, and it can be a great source of passive income. And he firmly believes that you can gain vicarious benefit through others' efforts. And it's an intellectual pursuit. Depending upon your interest and skills, you can gain massive wealth in this investing or financial markets. So very warm welcome, Kedar. So just in case I missed anything, I would request you to tell about your venture, and you can add to your introduction in case I missed anything.
Oh, yeah, sure. So thank you for that elaborate introduction. So yeah, I guess you covered most of the important points. So a couple of things I would want to add is I guess this is the third or the fourth time we are collaborating on your platform. But then
Right.
yeah, first time in the video format. So it's always pretty interesting to come on to platforms like this and get a sense of how the retail investors are actually thinking, how are they sort of progressing in their entire investment journey. So I personally find that very fascinating because this is how I started off as well as a retail investor who eventually ended up working in the financial markets. So I also learned the customer perspective, dealing with a whole bunch of HNIs, family officers. So what we have tried to actually do at Congruence Advisors is to sort of, build further on all of my learnings that I've had both as a salesman and as an investment manager. It's been a very interesting journey over the past 5 years. So we are close to, I would say, finishing the 5 year mark. So in terms of performance, I guess we are tracking fine. We are close to, I think, 27% CAGR post fee over a 5 year period, thanks to obviously the market, which has been doing pretty well. So at Congruence, what we are actually trying to do is we are trying to plug certain, I would say, white spaces or gaps that are there in understanding of the market from the retail investors' point of view. So if you look at all the sessions that we've done in the public media, we have always tried to bring out all of these perspectives one by one so that people can think deeper and deeper in terms of the various aspects of, let's say, doing bottom up stock picking, doing portfolio management, how do you calibrate to the various markets, how do you understand the operating perspective that is very important when it comes to, let's say, investing for the long term. So as a continuation of this entire series, so this time what we're trying to do is we're just trying to take a topic which is, I would say, well known but unfortunately not analyzed well enough in depth. So I guess diversification is something that everybody has sort of experienced, heard about, read financial papers about, read technical papers about. But then my experience has been when you start off investing as a retail investor, we tend to look at it as primarily a very, I would say, a slightly theoretical sort of a concept. Because if you study the origin of this obviously comes from classical portfolio theory. But we believe there are multiple facets that are at play when it comes to, let's say, a simple concept like diversification. So that's what we plan to cover in today's session. So give you various insights into how we see diversification in the context of equity portfolio management for a retail investor. Try and explore various facets which are not really all that well covered in the public domain in the media. And then make a practical attempt to actually say what framework can the retail investor use to be able to use some of these learnings when it comes to doing investing real time. So on that note, just starting with the disclaimer. So we are a SEBI registered investment advisor. So whatever we say in this presentation taps into our own personal knowledge. I mean, personal experience, personal knowledge. Obviously, it doesn't amount to investment advice at all, because the investment advice for an investment advisor is very, I would say, one to one. So at Congruence Advisors, though regulatorily we are empaneled to advise across asset classes, over a period of time, we've decided to do only direct equity, build differentiated equity portfolios for the affluent segment, which can complement their investing, I would say, existing investments into a whole bunch of mutual funds and whatever direct equity or PMS offers. So on that note, let's, yes. So just a couple of, more disclaimers, because this is the, I would say, the occupational hazard of being an investment advisor or a equity fund manager. So we'll be sharing a lot of information that is built of our own personal experiences of speaking to a whole bunch of other experienced investors in my network. So whatever learnings in investments, it's obviously stated within a particular context. So please do not take any of these learnings out of context. Now, whatever practical examples we give, you can assume that we have had or we have investments in some of the stocks that are going to be taken as examples. Now, subject to human error, obviously everybody can be wrong. We have been wrong on our analysis in the past, and it's very possible that we could be wrong on certain things going forward as well. So any sort of a forward-looking projection or a statement obviously are made with the best of intentions, but they can always be wrong. So you should always do your own due diligence on the profile, the background, the performance track record of every single speaker before you actually start implementing some of their learnings and some of the, I would say, the gyan that they tend to give on all of this class. So on that note, just a quick introduction. So I guess it's pretty obvious in terms of what the importance of diversification is, but at the risk of reiterating some of the core principles without spending too much of time here. So the core principles, at least the way we see it, is this: what are we trying to achieve through diversification? We are just accepting and hedging the limitations of our own knowledge and analysis. You can do all the analysis that you really want, but at the end of the day, analysis and knowledge has its own learning. What we have discovered is that over a period of time, once you track a particular stock or a sector for, let's say, 2 years, 3 years, that is when you start having a fair amount of depth of analysis. After you do the Excel sheet work, after you, let's say, go about doing channel checks, speaking to the management if you really want to. So the primary point is sometimes we aren't even cognizant of what we don't know. And we end up operating on, I would say, half knowledge or semi-good knowledge. And so a very interesting quote by Mark Twain: it's rarely what you don't know that gets you into trouble. It's what you think you know for sure, but actually the ground reality is different. That is what gets you into trouble. So what happens is people end up betting with conviction on the wrong investment or at the wrong cycle in the market. And then that is where all accidents tend to, happen. So accidents tend to happen when the confidence level is actually very, very high, when you are, I would say, not cognizant of your own blind spots. And contrary to what people think, a lot of professional investors have blind spots in their analysis in terms of their thinking. And it's not that every single professional investor has a very, very wide coverage universe. So having a coverage universe of, let's say, more than 200, 250 stocks is extremely difficult unless you have like a 10-member, 15-member team. So even professional investors, for all the access to resources and the best, I would say, the employees that one can get, end of the day, it is very, very difficult to be absolutely sure of what you're doing. It is very difficult to have all the data points in hand. It's very difficult to be completely up to date in terms of what's happening in various sectors. So the final result of all of this is that even if you have a thesis that's very, very well formed and you have tested it out, if you've done back testing as well, it can always go horribly wrong. So that can either happen because of, let's say, some sort of a gap in the analysis, some sort of a gap in the qualitative understanding we have about the business or the management actions, or it can happen because of, let's say, investor misjudgment, which brings us to the second important point. So what happens is now as an investor, you will realize this over a period of time. You will have, let's say, good times and bad times as well. So the best example for investing is actually cricket. So in cricket, you have the best batsmen who are sometimes in very good form. I mean, whatever he touches, first ball, you just hit the middle of the bat, right? Certain times you just can't put bat on ball, or you just can't hit the middle of the bat. You tend to hit the ball in the air. Some little deficiencies in your technique is going to creep up into your game over a period of time. So purple patches, lean patches are very, very common for investors as well. And the worst case scenario of something like this is when you go actually double down on something with conviction after your style goes out of favor, or let's say the stock cycle has completely changed, or the market cycle has completely changed. So that is when you get into trouble over the medium term. Now, over the long term, obviously, it is earnings growth which will predominate whatever return the investor is able to generate. But then, if you are focused on the medium term, then sitting with, let's say, a bit of underperformance in a bull market because you are loaded up on the wrong set of stocks, the leaders of, let's say, the previous run that have gone out of favor. So, what diversification essentially does is this: it ensures that your entire portfolio is not at risk of any of these factors. That's the primary core principle when you talk of diversifying an equity portfolio. Now, putting this in context of what's happening in the world today. So, if you study the origins of diversification, the whole concept was if you take two assets that are negatively correlated, what happens is volatility in one asset class will probably be compensated by the other asset or the other asset class. Now, what's happened in today's world is you have the era of money printing where it is primarily liquidity and I would say central bank action that is generating the market beta in this particular case. So, what we have observed is this, and this is very valid post, I would say, the financial crisis of 2008. What you will see is you will see that multiple asset classes are actually moving in tandem. You will have situations where equities are falling, bonds are falling, commodities are falling, everything is falling, real estate is stagnant. Some of this behavior in the modern era is actually contrary to the old school finance assumptions, which assumes that bonds and equities are counter cyclical. So, a lot of assumptions that are actually gone into the theory of diversification may not be as relevant today as they were when the theory actually came out. And it is, I believe, diversification becomes doubly important in the financial influencer economy, which has really taken off in India in the past 3 4 years. So, what tends to happen is if you're a young retail investor who's getting started today, I mean, people tend to obviously prefer audio visual forms of learning today compared to, let's say, reading books, right? So, what happens is you go on YouTube, you go on some, I would say, platform, you listen to an influencer, and initial phases, basic human nature says that we tend to get influenced mostly by how convincing the influencer sounds rather than the quality or the depth of thesis. So the bottom line is the market doesn't really care about how convincing a particular thesis sounds or how strongly an influencer is actually able to position his own idea. So end of the day, smart marketing and hooks to be able to, let's say, latch on new subscribers or customers, it cannot really substitute real odds in the marketplace. So I think there are certain things that we need to be very, very cognizant of in the situation today. So this is where diversification becomes very, very important for the average retail investor today, who's actually entering the market when the going has been pretty good for the past, say, 2 or 3 years.
So Kedar, when you say, I mean, can you, yeah, previous slide. So the retailers, those who have blind spots, can be taken care of with the help of the professionals, right? But when we talk of the professional investors or the fund managers or investment advisors, also come across these blind spots, or there are some limitations to their coverage in the universe. So how they can mitigate those blind spots, or so that broadly on the portfolio level, the impact is not much.
Yeah, sure. So to answer that question, I would say, see, one aspect is obviously diversifying at the portfolio level. I believe that in the initial phases, your sources of knowledge should also be equally diversified. So, in fact, this is something that we tell every incoming subscribers at Congruence Advisors as well. So, when we sign up a customer, what we tell them is please don't start off with a very, very large allocation to a single advisor or to a single fund manager. So ideally, you should probably start engaging with 2 or 3 people, and then over a period of time, actually figure out how the entire engagement works for you. And then you have to understand what is it that you are intuitively comfortable with, and what is the strategy that you are able to execute consistently in the marketplace. So I would say, in terms of knowledge sources, number one, don't listen to just, let's say, 1 or 2 people. Learn from as many diverse sources as possible. Read books. Obviously, use YouTube as a learning channel. Go, I would say, follow multiple people on Twitter. So that is where you will build an appreciation, saying there are multiple ways of, being successful in the market. So it's not that there's just one particular approach which you need to really stick to. So I guess being diversified in terms of your thought process as well is the real value addition. And that is what should ideally reflect in the portfolio as well. So be diversified across thought processes, across learning sources, across strategies, before you eventually decide to, let's say, work with maybe 1 or 2 people, and then you can sort of become more focused in your entire learning and investing journey. I would put it that way.
Great. Thanks.
Okay, so quickly moving on to the next slide. Yeah, so the fundamental principle of the markets is this: cyclicality, mean reversion are always at work. Always at work. Go back in history to every single bull run, you will always get the feeling this is the best way of doing things, but the style that works today will eventually go out of favor. The asset class that is in favor today will eventually go out of favor. That's just the nature of the markets, and that's human behavior. Rather than, let's say, putting the blame onto, I would say, the asset or the asset class or the stock in this particular case, this is just human nature. We end up chasing performance, which eventually leads to a reversal of cycle. So you study various asset classes. We've just taken a couple of examples. So just look at the real estate boom that has materialized across urban India post-COVID. So 2013 till about 2021, real estate basically went nowhere. Once we started coming out of the COVID shadow, the narrative actually said that real estate is probably going to go into a little bit of a lull because work from home, people have started moving back into their hometowns. But then see what happened starting from 2022. The narrative completely flipped. The real world behavior is something totally different. So that's a very practical example. Now go back to, let's say, the US market. Go as late as, let's say, the 1970s. Read on Wikipedia about the Nifty 50 crash. So what we have on the screen over here is the monthly chart of the S&P 500 index. So you can see that starting from the period of, let's say, 1974 onwards, whatever money you put into the market, you were red for the next almost, I would say, 7 years. And this happened on the back of a spectacular outperformance in the broader index. So if this can happen to the US market, obviously it can happen to anybody as well. And it's not as if the US economy went into recession at the point of time. There were challenging times, there were decent times, but the market just didn't perform. In more recent memory, if you go back to 2022 and look at the global fixed income crash, once inflation as a trend actually started picking up big time, you will see that in 2022, if you'd held, let's say, a treasury ETF, 20-year treasury ETF return was minus 31% in one single year. And bonds are supposed to actually be the safer assets, right? So these two examples sort of completely tell you as to why having multiple thought points of view is very, very important, and why diversification makes sense in the context of the overall portfolio. Another recent example, more in the Indian context, is this. So if you'd gone to, let's say, 2021, 2022, the narrative basically said that diversified conglomerates, these are always going to underperform as investments. And you were right. If you had looked at the past 10-year history, a lot of these businesses had underperformed significantly. The market loved capital efficiency. The market loved niches that could just keep growing at a very predictable and a secular rate over a period of time. But then since then, if you actually go and measure the performance of some of these so-called diversified conglomerates, so ITC, L&T, effectively these are conglomerates, right? So you have multiple businesses, multiple cash flow cycles, all sitting in the same entity that is listed. But look at the performance of all these guys. Look at Aditya Birla Group stocks, look at Adani Group stocks. So even if the management is, let's say, not completely focused on a single business, so what we are saying is the narratives also tend to keep changing, and the narrative changes, the performance changes. Usually it happens the other way around. The performance usually starts getting better, the narrative suddenly changes. So the core takeaway of this slide is this: the need for diversification actually emerges from human behavior, from lacunas and I would say biases in the human behavior. It is not because of the assets, it's not because of the asset classes. Because the nature of real estate doesn't really change in 50 years, right? The nature of a bond, if you buy a 30-year bond, it is not going to really change during the course of the bond. The coupon rate is fixed. But what can really change is how do investors think? How do central banks think? How do they tinker with interest rates during the tenure of the entire investment? So these are the reasons why people need to be diversified in the first place. This sounds very, very counterintuitive when you see the equity market doing very, very well. But trust me, this is pretty much needed. So diversification obviously is a very, very wide and a very broad context. But from the point of view of this particular discussion, what we are restricting the scope to is this. We are only talking about diversification in an equity portfolio for the retail investor, right? So you can do diversification at the overall portfolio level. There's a whole bunch of things that we can do, but we are limiting the scope of this discussion only to an equity portfolio for the retail investor. Yeah, so just offering some commentary on what we think is the state of equity investing when it comes to, let's say, the retail market in India. So this is something that we have noticed, and I would say I have also been guilty of this for quite a number of years before I have come into my current thought process. So picking winners has traditionally been overemphasized in India. So you talk to people, people are always chasing, let's say, the next multi-bagger stock, which is the next theme which can actually play off. Everybody wants a 5x, 10x sort of a return, which I believe is obviously justified because you're doing active investing, you have a wealth creation sort of a mindset, then obviously that's the right segment to fish into. But then, as a standalone basis, is that sufficient to actually get the job done over, let's say, the next 5 years or 10 years? That's where I would say, the gap in understanding actually comes. So while picking winners is sort of, overemphasized, what we have observed is that effective portfolio management. So what is your thinking in terms of managing risk? What is the mechanism you have? What is the methodology you have to minimize maximum drawdown in case things don't work out? This is very, very underemphasized. So what you tend to see is you tend to see retail portfolios where you have a good run for about 3 years, 4 years. You make 3x, 4x at the portfolio level. Then suddenly the run stops. Or let's say the particular segment that you've been focusing on, it goes out of favor. Then what tends to happen is your portfolio loses 40% from the peak. Then it's a very frustrating time for the next 2 years, 3 years, and then the cycle reverses again. So if you look at it that way, the principles of sound portfolio management go well beyond putting together a list of potential winners. So portfolio management isn't really about going and saying, okay, let me just go and pick the stocks with the maximum growth potential from it. So retail investors generally, what we've seen is that they can match professionals at picking winners. Sometimes they can actually do a better job because they deal with a lesser amount of constraints compared to the institutional investors. But we can improve a lot at portfolio building, especially if you start putting conscious effort. So once again, going back to the most practical analogy. So an effective portfolio that can get the job done for you as a retail investor over the next 5 years, it is a lot like selecting a cricket team. So when the BCCI or when the selection committee actually sits down to select a cricket team, what are the sort of questions that they really ask themselves? So they're saying, if let's say you're playing a knockout game final, suddenly your top order collapses, you're 35 for 3. From there, are you going to be 100 all out? Or do you have enough, I would say endurance in the middle order so that you can at least get to a decent score and give yourself a better chance of winning on that particular day? So basically, it means, do you have enough options that can fill in for a player who's actually having a very bad, right? So just drawing some parallels from there, what ends up happening is the complementary skills and multiple choices that you have at your arsenal. It can actually improve the resilience in a particular portfolio, even if you have to leave a little bit of money on it. So a couple of questions which I would encourage everybody to actually ask themselves is this. Now, if your selection pool isn't really broad enough, right? Now, we are talking of the selection pool. We're not talking of the portfolio being diversified enough. How exactly can you manage market pivots well? Because when a market pivot happens, you will discover that whatever the market is excited about today, suddenly they will just go out of favor, liquidity completely goes out. So if your selection pool isn't broad enough, the chances that you can manage a market pivot well is actually very, very minimal based on personal experience. And if your portfolio is driven only by, let's say a couple of factors, if you're overweight only a couple of things, then how will you be able to minimize drawdown when the tide eventually turns? And this is something that you have to discover only by personal experience. Go and talk to people who are overweight small caps in 2018 and 2019. I mean, being overweight is not a bad thing. There were a bunch of people who were doing only micro caps. 2019, 2020 was a very, very torrid time for them. So are you aware of what are the factors that are, let's say, driving your portfolio right now? If you're not even aware, how can you actually minimize the drawdown when the tide effectively comes? So these are some of the aspects that people need to actually think about when the going is good. Because if you don't do this when the going is good, once the market pivot happens, whenever it is, you will not have the time to do all of this, I would say, broad thinking. So before we head over to the next slide, any questions on this?
No, we are good to go. I'll ask as and when.
Sure. So let's proceed. So we're just putting in some suboptimal designs which pass off for good diversification. And each of these are practical examples that we have seen. Some of these are mistakes that even the best professional fund managers in India have made across the mutual fund and across the PMS space, right? So first example, buying only high quality businesses, but that are very, very expensive at the same time. And you're doing this across sectors. You're buying from IT, you're buying from FMCG, you're buying from banks, you're buying from pharma, you're buying from a whole bunch of sectors. In theory, the portfolio is diversified because you don't have an over reliance on, let's say, even a single sector. You will say that the Nifty has a 36% weightage towards financials. My weightage is pretty much, let's say, in the same range, plus or minus 5%. So in theory, this has passed off for diversification. In practice, look at the return from such a portfolio over the past 3 years, 4 years. Now, a caveat over there, 3 years, 5 years, obviously is not the best analysis, best time frame to actually evaluate an active strategy. It should ideally be much longer. But then this is an orientation from the retail investors' point of view. Very few people will be able to deal with outperformance or live with outperformance over a 5 year horizon, leave alone 10 years. 2 years, people tend to lose patience. So that's the first example. Second example, so buying only well-known stocks with a heavy FI ownership. Once again, this looks like a very, very diversified portfolio because where are FIs really overweight? Banks, IT services, consumers. So some of the best businesses in India, some of the best known stocks with the best corporate governance. But then wherever the FI ownership was like very, very high, once the liquidity starts going out of, let's say, a particular market, then what happens is these stocks will suffer purely because of a supply and demand mismatch, right? Because once the largest player in the market has been overweight a particular thing for a long, long time, the incremental buying force that is needed to be able to compensate for the outflow of liquidity and then for the market to actually take the prices higher is going to be very, very difficult to pull off. So buying only asset light businesses, but high ROC businesses. So if you're obsessively focused on free cash flow, I mean, what does free cash flow at the end of the day really do? You take the operating cash flows, right? You knock off whatever is the growth expenditure or the capital expenditure that you really want to do. Then you're left with a fair amount of money. What do you do with that money? Do you pay it back as a dividend, right? Or do you do a buyback? Or do you allow that to sit on the balance sheet and then start generating other, right? So free cash flow that cannot be used for, let's say, further business growth. If you cannot deploy cash flows as a business, then what happens is your growth rate will never be very, very high, right? And it kind of, feeds off each other. If you had enough growth opportunities, you wouldn't be sitting on so much of cash in the balance sheet, right? So this was another, I would say, suboptimal design which got exposed over the past 3 years. The other example got exposed, I would say, mostly during the period of 2012 up till 2019, where you're buying only optically cheap businesses, right? So there are some people who call themselves true blue value investors. I mean, nothing wrong with that approach as well, so long as you have a very, very long time horizon. But then if you keep buying only businesses that are optically cheap and you insist on, let's say, a very, very low PE value for the portfolio at an aggregate level, that basically means, once again, you're overweight just one single factor. And if that factor doesn't perform, then the portfolio is going to get into trouble even if you are diversified across market capitalization, across, I would say, industry sectors. So, and once again, this is something that has happened in the previous cycle. The risks that are actually there right now. Okay, the last 2 points that we put over there, we see it happening real time. So you have a whole set of people who are buying only economy facing stocks. I mean, people are loading up on defense, people are loading up on capital goods, people are loading up on industrials, right? Saying India is going to be the fastest growing economy, if not the fastest growing, maybe at least in the top three for the next 10 years, right? So the RBI is projecting a 7.5% GDP growth rate for FY 25 and 26. So then you just make your mind up saying, I will buy only economy facing stocks, right? And then you suddenly see that IT services is running up, consumption is running up, right? The so-called technical defensives. I mean, there is a method to the market madness, right? It looks like madness, but the market is usually very, very smart. So this is introducing yet another bout of fragility because you are just once again overweight one single factor, which is the India shining narrative, right? You end up buying only from the hot sectors of the day. So people who are today looking at a whole bunch of technical indicators, you look for what is the, let's say, the best performing sector over a 6 month basis. You look for sectors that are showing a lot of relative strength right now. The stocks that are actually starting to find their way into the momentum based, let's say, ETFs or portfolios. And then you are basically building up yet another fragility in the entire portfolio. So all of these, in a theoretical sense, you can make the case saying we are diversified because you're buying across pharma, you're buying defense, you're maybe buying consumer as well. But then the point is, there is one or two factors that are still very, very overweight in your particular portfolio. As and when the tide turns, you will see the impact of the portfolio. So, a simple practical exercise for anybody to do: just observe the structure of any portfolio closer to its peak, right? You can observe that there is an over reliance on, let's say, a few factors, maybe one or two factors, even if the portfolio is well spread across sectors. So, in theory, once again, you are diversified. In practice, the real world outcome is totally different. So, what we always suggest is this: you should always think deeper than just superficial, I would say, parameters like market capitalization and sector. There are many, many more facets that you have to actually think about. And this is what we're going to be covering about in the rest of the slides from here. So, yeah.
So,
So,
Kedar, the points, the very pertinent points you just highlighted. So, if there are any examples to these that would be helpful in the sense people would be able to relate better. So, any case studies of the past to, if not the all points, but a few points which you covered.
yeah, sure. So let me just give you quick examples for the last 3 points. So optically cheap businesses. All industrials were extraordinarily cheap in the period starting from 2020 to 2019. Infra companies, EPC companies, people would say nothing more than 15p. So it was optically cheap, but then they were cheap for a particular reason, right? Yeah. So coming to the other two things. So if you buy only economy facing stocks in India, so we believe that some of the segments are priced to such an extent. Now, the point over here is they are obviously reflecting the order books, they are reflecting the current growth numbers. But what ends up happening is, let's say you figure out that cables and wires, okay, to take a practical example. So we had investments there till recently, till about 3 months, 4 months ago. But since then, we have cut exposure to more or less most of these stocks. Now, those stocks obviously have continued to move higher. But we are saying if you buy only economy facing stocks in India, right? You buy cables and wires, you buy only EPC players, you bought only industrials, you bought only transformers, you bought only capital goods, where most of them are deriving their demand only from, let's say, government capex spending, primarily from government capex spending, primarily from, let's say, defense spending by the country. So defense is a classical example, right? So if you do this, what happens is valuation obviously is a function of multiple things, right? One of the best mental models to actually use is this: whatever you know, what is it that you know that the market doesn't? Because whatever you know, if the market already knows that, if that already reflects in the data points, then what ends up happening is it will be priced accordingly. So it is always good to take a look at the price versus the growth. You need to find a mechanism of, using both of them in unison rather than just being growth focused, right? So hot sectors of the day. So today, I guess everybody is talking about data centers, right? But if you actually slice and dice and see which are those focused, let's say 5, 6 players who are actually coming and saying, I will directly benefit from the data center. And there's a lot of narratives in the market. Suddenly, there was a narrative that said the lubricant makers are going to benefit from, let's say, use in the data centers going forward. And then you had the lube makers coming and saying, no, we don't really expect to benefit from that. So in terms of such narratives, so these are perfect examples in terms of how people are actually huddling into the same set of themes or the same set of sectors without taking an overall portfolio. Without taking an overall portfolio.
So, Kedar, lately a similar question on the first point, which you highlighted, the high quality but expensive businesses. So, the person was saying that he and his friends started around the same time with the same capital. He ended up investing in the companies, the favorites of the likes of Asian Paints, HCFC Bank, and all. And you have seen in last 2, 3 years, the performance has been pretty not as per the broader market, you can say. So he was asking, despite having quality businesses, and my friend invested in the railway and defense team, as you were pointing out, he ended up making good money. So where I was wrong. So would you like to throw some light on that?
Yeah, so in a sense, see, what is wrong or right is eventually a function of time and place. It would have been absolutely the right thing to do when India was not growing. See, if you look at it that way, there was a brief period of time in India where only the top businesses were growing. So the market loves earnings growth, right? So wherever you see earnings growth, people will keep paying higher and higher valuation for that. So that's a common theme that basically runs across. So today, if you see, why has railways worked out? Why has defense worked out? Because they were under-owned as a starting point. They were offering you a very, very low valuation as a starting point, right? And then they started delivering on the numbers. So order books are getting better. Managements are able to execute. Now we have the political and the policy continuity questions also getting answered to a great extent in the past 1 month. So I would say the person was not really wrong. But but the mistake that I would say that has happened in a lot of portfolios is this. He was overweight just one single factor, that is high quality. So this is exactly what we're talking about. The market investing is a social science. There is nothing definitive about this. As a strategy works really well for 3 years, 4 years, you will find practitioners of that strategy occupying the highest amount of media time. So these are the people who will come and say, this is all we do. This is what we will do. This has worked for us. It works for a particular period of time, but then eventually you never know when the tide is going to turn. When the tide turns, often what you will see is you will see businesses growing at a decent rate. 10%, 12% growth is continuing in some of these names that you do. But then the valuation was so very high. So what we are saying is when you're diversified, what ends up happening is you don't have that blind spot. So I would say it's more a question of keeping your mind open and not being completely closed, and your ability and willingness to try out multiple things and leave some money on the table. That is what determines how well you manage a market you are.
Right, we can go on next.
Okay, sure. Yeah, so in a sense, now coming to the finer aspects of diversification, which is like the core, I would say, the message of this entire session. So there's a lot of confusion that we see. So, for example, people tend to see diversification and concentration as, I would say, two poles apart. So, is it really a binary choice? Right? This is a question that I've always been asking myself. So, just to give you an example, let's say somebody is running a portfolio this way. So, you have three large positions which are high conviction bets, right? So, it is, let's say, 15% exposure to these three positions. So, you have three stocks that are 50% of the portfolio, and then you have 20 smaller bets to make up the remaining 50%. So a portfolio like this one, where exactly do you slot it? Do you call it diversified? Do you call it concentrated? So it's never really a binary choice. It's never really a binary choice. The second underappreciated factor is this. Most portfolios start out with a fair degree of diversification. I mean, they may not be greatly diversified, but you won't find too many people going out and saying, I will buy only 5 stocks because I understand all of this very well. Generally, people start out with some degree of diversification. 3 years, 5 years, what ends up happening is some of those bets do disproportionately well. So you start with, let's say, a portfolio of 5 stocks. You put, let's say, 20% into each stock. Anyway, wrong example. So let's take 20 stocks. 20 stocks with, let's say, 5% allocation to each stock. Now, all those stocks are not going to run at the same pace, right? So 10 years down the line, you will probably see that maybe the portfolio resembles the first example that we've taken. 3 of them work out really disproportionately because they've gone at 7x, 8x, 10x. Some of them don't perform at all. So that 5% allocation automatically falls to a 3%. So what we have seen is this: concentration should ideally be a function of conviction and deep knowledge about a particular business or a particular sector, right? Otherwise, concentration will probably work against you, right? So people shouldn't wake up in the morning, study successful investors, study their portfolios and say, okay, you have X and Y so-called gentleman who has 50% of his net worth right now in a single stock. What you're seeing is the outcome. It was not the starting point, right? So most portfolios actually start out diversified, and then concentration is basically a function of the deep knowledge that an investor gained about that. He would have probably added more over a period of time because the business was performing well, right? So don't see diversification or concentration as a binary choice, right? Now, the behaviorally, one of the most important things is this: if for you to make a 10x, 20x, 100x, if that's what you want to do, it cannot happen in a short period of time, right? You need at least a 2 year, 3 year window. Usually, you end up needing something between 5 years and 10 years if you do things right. Otherwise, you can be an investor for 50 whole years and not have a single 50x in the portfolio. That is also absolutely fine so long as the portfolio return is okay. So, for you to succeed and outperform over the long term, most important thing is you need to survive in the near term, right? So just put yourself in the shoes of an investor who started investing, let's say, in 2006. So 2006, the narratives in India that were very, very strong. You will see companies that were really loading up on debt. People wanted to put up capacity. Banks only wanted to do, I would say, primarily corporate lending, because corporate lending, you can really move the needle, right, in a matter of 6 months. Whereas retail is mostly granular lending. You need to put in systems in place. Your cost structure initially dominates and all of that. 2006 it worked out, 2007 it worked out, but 2008 it was a macro event that had absolutely nothing to do with India. But people who were completely overweight those 1 or 2 factors, they ended up getting decimated to an extent in 2008 and 2009. A lot of them have moved out of the market. They have just completely moved out of the market, right? You don't want to be one of those unfortunate examples. So what happens is, so diversification and concentration can actually happen at the same time, and it is something that can evolve rather than seeing this as a binary choice. Another practical example. So if you look at entrepreneurship, what is entrepreneurship? So an entrepreneur is somebody who has a disproportionate stake in a particular business in which he has operating control. But end of the day, the instrument that is leading to wealth creation is the same, right? It is stake in a particular business, right? It's just that you will have a majority stake in an unlisted business rather than holding, let's say, a very, very small stake in a larger business. So entrepreneurship, where concentration is usually taken to the extreme, right? You will find extreme range of outcomes over there. You will find some people who are really, really successful, but the failure rate is very, very high, and that basically tells you something, right? So extreme amounts of concentration as an objective by itself is usually self-defeating unless you are really lucky or you're really risky. So we would suggest everybody to not see diversification and concentration as two ends of the spectrum. It is something that, it is something that you need to evolve into over a period of time. The other, I would say, I would say not a misconception, but the rather underappreciated aspect of diversification is this. Is diversification about risk management alone? Is that the only objective of diversification? If you consider the behavioral aspects of what goes into the mechanics of diversification, right? Now, if your coverage universe is diversified, your idea generation will always be decentralized, right? And this is something which we have practically seen over the past, say, 4 years, 5 years. So if you'd spoken to us, let's say in 2020, 2021, we didn't have the kind of coverage that we have today across the economy facing pockets. But what really helped us to manage the 2021 pivot was this, right? We diversified our coverage universe. Once we started there, we were able to appreciate what was happening in various pockets of the Indian economy, which allowed us to calibrate the portfolio, which allowed us to eventually get into newer and newer portfolios, which started making the portfolio a bit more diversified. So diversification of the coverage universe is a very, very good starting point, which will eventually help you with idea generation. It is going to help you with alpha generation as well. And eventually it's going to make your portfolio more diversified. Behaviorally, what you own is what you track very intensely, right? You can watch a video on, let's say, data centers and the so-called demand of that particular industry today. You can try and understand why are chemicals so beaten down over the past 3 years. But understanding and true tracking comes only when you actually go and own something. So as a retail investor, this has been my experience once again. The best way to force more analytical rigor into yourself is to own more stocks. And interestingly, whatever retail portfolios we have seen they're either at one of the ends of the spectrum. Either the portfolio has more than 50, 60 stocks, or the portfolio has hardly 10 stocks. So tying into the first point, so people seem to be choosing either ends of the spectrum based on either, I would say, either consciously, unconsciously, whatever it is. We have rarely seen portfolios that have 20, 25 stocks where the investor is able to explain to us why are you choosing this particular theme, this particular sector right now? Why not something else? So the best way to actually force more rigor for a retail investor is to make yourself own, let's say, 20, 25 stocks, right? So that way, your coverage universe gets more diversified. You tend to do more and more work on certain sectors that improves your overall, I would say, knowledge and understanding of the market. So, I mean, understanding 15 plus sectors as a part-time investor who's working somewhere else as a full-time employee. I mean, if you're excessively focused on just 15 or 20 stocks all the time. So for you to build a 20 stock portfolio, your tracking universe needs to have at least ideally, let's say 80 plus sectors, right? So what does diversification end up doing? Though that is not really the theoretical objective of diversification if you go by financial theory. Diversification, in our experience, it ensures that you will not miss the forest for the trees. And you will end up discovering pockets of potential alpha in a timely manner, which means 2021, 2022, you figured out saying consumer numbers are okay, but stocks are not performing. For some reason, stocks are not moving, but stocks are moving in some other pocket of the market, right? If your thought process was diversified, ultimately your portfolio would have reflected that, and potential alpha comes to you much more easier when you're diversified. That's a very, very underappreciated aspect of, I would say, diversification. And this is something that we had to make mistakes and learn through personal experience. So, summing up the personal experience, alpha generation in our case, it has become more consistent after the diversification in our case has actually gone up. So earlier, we would always beat the market over a 5 year horizon. But what would happen was in my personal portfolio before I started managing capital for other people, there would always be the 2 year period where the market would be at a 10% return. I would be sitting at 2%, 3%, which is significant underperformance. Then eventually it makes up. But then the alpha generation today has become much more consistent after I became more diversified in terms of my thinking, in terms of, let's say, a better coverage universe, better idea generation, and eventually a more diversified.
So very rightly said that survival is important. So as to ensure survival across cycles, what it takes on the behavior side, Kedar. And secondly, one question comes to my mind when the debate of concentrated versus diversification is there. And as you rightly said, concentrated portfolios are usually an outcome. So basically, when a particular stock, or you can call a winner, which has like a major part of your portfolio in. So would it be wise to write that winner, or it's always good to have a capping on the allocation in one particular stock?
So that's a very interesting question. So this is something that I'm grappling with even at a personal level, right? So the largest stock in my personal portfolio, even today, I would say it is more than 25% of my overall net. That's because when I bought that stock, I took a 7%, 8% sort of an allocation at cost. That stock is probably up something like, I think, almost 50x today. Okay. And today it is 25% of my net worth, even after I have pruned the holding by about, I would say, at least 40%. So, practical example. So, unfortunately, there is no direct answer to this. So, I would say it is better to take inputs from a host of factors on this, right? So, it also is a function of at what stage of life are you at? If you're still in the alpha generation phase, I think it makes more sense to keep riding it if your business analysis tells you that the business can keep growing at a high rate for the next, let's say, 10 years or 15 years, if that's your assessment, even if the business is, let's say, slightly cyclical. Whereas if you're already at a stage where you think you are reasonably happy with where you are on the wealth spectrum, then it's a totally different sort of I would say, an action that you really need to do, right? But on an average, I can tell you this. I would have been much better off if I had not pruned exposure to that particular stock. But then the point is, such stocks are only outliers, right? Such examples are only outliers. You will rarely find examples where a company that's today trading at a 300 crore market cap ends up becoming, let's say, 1 lakh crores over a period of 10 years or 15 years. I mean, two stocks like that will completely change your own personal net worth, right? So I think that is a little bit of an extreme example, right? Practically what ends up happening is you will take exposure to a particular stock, it runs pretty well. So how do you evaluate saying, is that a winner that you need to ride, or is it something that you really need to prune? It's a function of, I would say, mostly bottom up analysis about that particular thing. But as a rule, you should have some threshold in mind. So in the portfolios that we manage, we follow some basic rules. So even if a stock works out pretty well, beyond, let's say, 10% exposure at a market level, we tend to come in and prune, because we are managing external capital for people where I think we need to be much more responsible. Whereas if I had to do the same thing for my personal portfolio today, my threshold would maybe be slightly higher. Maybe I would work with a 15%, 20% number rather than a 10% number. So it comes down to your objective sprints. It also comes down to at what stage of life you're actually sitting at. And more importantly, if you have any heavy financial commitments for the next 2 to 3 years, I would put it that way. It's a it needs to be a very, very well-rounded thought process when it comes to this.
And Kedar, we are in an era of noise, or you can say the attention span is decreasing these days. So, in that case, so as to increase the coverage universe,
Mhm.
don't you think like going to more number of stocks will, I mean, obviously that is a gradual progression rather than happen anything in a short period of time, but don't you buy this statement that when you are like looking at many stocks, your focus or maybe the depth of understanding of one particular company is comparatively limited?
Yes, I completely agree. So that's once again, that's a very, very interesting trade-off. I mean, I've seen investors who are on both ends of the spectrum. I've seen and both of them are equally successful, by the way. Some people, they just like to get to such a level of depth about each business or each sector, and they tend to fish only in those pockets that they are actually familiar with. But then those are the outliers. Most of the time, if you look at, let's say, the medium term return is highly correlated to whether you are exposed to the alpha generating pockets right now or not. So medium term is what we define as the next, let's say, 3 to 5 years from now. Long term, I think it becomes more business specific rather than portfolio construct specific. Whereas if you talk of the medium term, if you are not having any exposure to the sectors that are doing really well right now, there is no way you can actually outperform the market. So from a retail investor point of view, given the fact that, as you said, the attention span is actually pretty limited, similarly, investment horizon is also fairly limited, right? You don't find too many retail guys who are actually able to implement a 10-year strategy. If you are able to implement, I mean, that's a totally different group that we are talking of. But most people we have seen, I would say 90% are looking to get a good return in the next 2 to 3 years. So if that's your investment horizon, then I guess it is in your favor to not focus on depth beyond a particular level. You need to cover your bases. You need to understand the long term growth drivers of a particular business. You need to understand valuation. You need to have a view on management quality. But beyond a level, if you figure out that this is a particular sector where numbers are getting better and the re-rating is, kind of currently underway, the best suggestion in a good market is to basically participate even if your depth of analysis is not very very high. Depth of analysis, I would say, is the biggest determinant if you want to hold a business long term. Medium term, I would say it's more of being in line with where the market is going to reward you rather than thinking. I guess it's a slightly unconventional answer, but then medium term, this is what we have discovered through experience.
Does make sense. We can continue.
Okay, sure. Okay, so now we will just focus on, let's say, the various parameters that you can consider beyond superficial things like market capitalization and, let's say, sector allocation. So when we talk of, let's say, having a diversification framework, which are the other parameters that you can use to actually slice and dice businesses so that you get a better understanding saying this particular business, what is it going to add to your business, right? We're just covering, let's say, some of the points here. Now, these perspectives are not exhaustive. You can probably maybe add more perspectives to this as well over a period of time. But these are the basics that we try to do on a regular basis at Congruence. So first perspective, is it a secular or a cyclical business? So once again, go back to the market pivots of 2018. 2018, the market cared only about secular businesses. 2021 onwards, it's been mostly cyclical, where the secular businesses continue to do well on the business front, but the stocks haven't really performed. So over here, when you look at a business, when you look at your overall portfolio, ask yourself, where are you more overweighted? Are you in the secular business sort of a bucket more? Are you sitting more on the cyclical businesses? Or are you currently running with a combination of it? So over here, once again, the analysis needs to be bottom up, and you need to be focused more on the expected earnings and the valuation comfort you have given the expected earnings rather than extrapolating the recent trends. So in this regard, I would say the last 3-4 picks that we have added to our portfolio at Congruence Advisors, they all look overvalued in an optical sense. But we know that in FY25 and FY26, once the expected earnings spike comes into these businesses, they will probably be very, very reasonably valued. So the whole point is this: you always need to be focused on expected earnings and the valuation comfort given your assessment of the expected earnings. Otherwise, the entire theory, the entire gyan in the public media will always tell you should buy only secular businesses. Don't buy too many cyclical businesses, which we believe is sensible advice for most people, but it should not be taken to the extreme. Okay, so that's one factor. Second factor, fairly obvious. So you have domestic economy focused businesses versus export focused businesses. So today we are in a situation where everybody is gung ho in India. FPIs are gung ho. You have a lot of money coming in from the domestic family offices. People are saying equity is the asset class that is going to do really, really well. If you go back in time 10 years ago, the situation was exactly the reverse. Exactly the reverse. So just study the trend of the rupee starting from 2012 till about 2015. So the rupee went from, I think, maybe 52, 53 to a level of 70 in a matter of hardly 1 year. So INR depreciation was like a huge, huge theme in 2012 and 2015. So at that point of time, anybody who held exposure to businesses that had their demand setters sitting outside of India, if you're billing in non-INR terms, you're billing in euro, you're billing in USD, those businesses were by default giving you a reasonable earnings growth, even if the core business was not really doing well. Right. Just give me 1 second. Yeah, sorry about that. So yeah, domestic economy focused and export business focused. So this is another thing, because this is where you tell you which is the narrative that you're really overweight on. And generally, if you study the history of IT stocks tend to do well when the domestic economy businesses either they have very poor earnings visibility or they are fully priced in. And right now, if you see, I think it is more of the second scenario where the market's taking a call saying, given a choice between buying an ABB at 70p, 80p, I would rather buy a TCS at maybe 30p. That's how the FPI is thinking, right? So moving on to the third fact, tying this back to some of, let's say, the examples of superficial diversification that we spoke about. So always ask yourself the set of businesses that you are owning, right? So are they undervalued optically? Are they fairly valued, or do you think they are fully priced? Right? Once again, undervaluation is something that needs to be seen in the context of expected earnings and not really the trailing 12-month earnings, right? And for you to have a view on what are the expected earnings of a business, you need to do some amount of fundamental work. A pure PA approach, I mean, there are ways of making it work, but then it always gives you more conviction if you can understand the business and say, okay, either you will have operating leverage coming into the business, or you say that the order books are actually growing. I'm expecting the earnings to definitely get better. There could be mean reversion that is happening on the margin front. So those things are the perspectives that you really need to consider. So continuing on the same example, if you stick to fully priced in businesses all the time, and if you do that as a secular strategy, it is very, very risky because the valuation risk in the portfolio is going to work against you at some point of time. On that note, high valuation should not be seen as a proxy for business quality. It should not be, because this is one of the most unfortunate narratives that has come into the Indian market in the past 5 6 years. People are saying if a business is trading at a very, very high valuation, it means it's a high quality business, which means the price will not really fall. I think the market has proven to many people multiple times. Right. On that note, I would say if you see a massive price correction, it's actually better than seeing a massive time correction, because price correction may the price falls 20%, 30%, it triggers some sort of an action from your point of view. Price correction, where the price just hovers around in a particular range, 3 years, 4 years, 5 years frustration, where you keep saying, okay, it's a good business, I will keep holding this business. And in the meanwhile, the market delivers a return of 15%. So that's a very, very unfortunate situation to be in. So always be cognizant of which end of the spectrum your portfolio is actually sitting at. Are you only in undervalued businesses? Are you only in fairly valued businesses? Or are you only in fully priced in businesses? Because that tells you what your overall style is, and that tells you where the vulnerability of your portfolio is actually there. Fourth parameter, ask yourself, is this business model an emerging business model, or is this a mature business model? Right? And emerging business model doesn't necessarily mean technology, right? Going back to the example of, say, the previous infrastructure bull run in India. So 2003, 2007 was a time when the Indian government didn't actually have a lot of tax collections, weren't really great. So what they had to do was they still had to do infrastructure spending. So they said private public partnership, right? PPP was a real buzzword at that point of time. Then people were saying build, operate, transfer model, where you build, you operate it, and then you recover your cash flows over a period of time, and then you transfer that to the eventual owner of the business. But over there, what happens is, as a business, if you sign up for the BOT model, you can win a lot of business, but your cash flows get affected, and you have to obviously load up on debt to be able to put up that capacity. So that was an emerging business model at that point, right? So is your portfolio overweight? What are you buying only mature business models? Are you completely discounting the emerging business models? Or are you doing it the other way around? Example from the US market. So US market in 2021, I think market literally went bonkers. I mean, take examples of, let's say, the stock price of the platform that we are currently using, Zoom. Just look at the stock trend. Look at the stock trend of this company known as Peloton. I mean, the market just did bonkers because people just said it is going to be the digital model that is going to completely dominate the market for the next 10 years, 15 years. Old economy business models, nobody really cares about. And this set up investors for a huge, colossal sort of a failure, right? And it's not just retail investors, professional investors were set up for failure as well. So what happens is there is a fair amount of cyclicality in terms of this parameter as well. So there are times when the market really hates, I would say, the emerging business models. The market says no. Let me just stick to the proven, tried and tested models. I'm not going to really waste time looking at the newer models until they prove themselves. And there are times where the market says, "Bhai, पुराने में कोई मजा नहीं है, कुछ नया चीज दिखाओ." So that's when you have all the new economy businesses listing at a valuation which you cannot justify. Clear cut example India is when Nika listed. I think it listed and traded at what, 1 lakh crores within the first couple of days. 1 lakh crores of market capitalization at that point of time was given to just three businesses within the FMCG space. Just three businesses. So be it that a company which is like a newer entrant, which is trying to do a lot of things where the unit economics is not really one, the market was happily giving it a valuation of more than 1 lakh crores while undervaluing some of the more traditional businesses. So this parameter, I believe it becomes very, very important during the later stages of bull run because that is when the IPO market becomes very, very wide, right? So just ask yourself every single business, think on each of these parameters and start making it. So moving on to the next slide and quickly covering some of the other parameters that you can consider, right? So businesses within the same value chain. Classical example, you have auto ancillary versus auto OEM. You have a wealth manager versus an AMC. So if you look at it this way, an auto ancillary makes components and sells it to the auto OEM. The auto OEM sells it to the end consumer. The AMC has to sell through the wealth manager as one of the channels. So over here, one of the most useful tools you can have is to actually track the profit pool. Now, profit pool within a particular industry or a sector, sometimes it just moves across the value chain. Sometimes you will see that the wealth manager becomes more powerful than the AMC. Sometimes you will see that the AMC becomes more powerful than the wealth manager. So profit pools moves across the value chain based on power imbalances. 2019 post the first expense ratio cut. You should have seen the performance of the AMCs. I think HDFC AMC, which was trading at a 35 PE, it got related to I think 61 or 62 PE within a very, very short period of time because the market figured out that the entire cut in the expense ratio was being passed off to the distributors, right? Over there, in a relative sense, I would say AMCs outperform wealth managers. But today, since then, if you see, it is the wealth managers who actually beaten the AMCs, right? These are businesses in the same value chain. So tracking multiple legs of the sector across the value chain, it gives you so many insights into business analysis as well. So big fish in a small pond versus a growing fish in a big pond, right? There are times where the market is obsessively focused on the total addressable market, right? So people say, fine, this is a company that is an e-commerce player, right? They are getting into newer categories, which means they will be able to capture some of the addressable market of the newer category over a period of time. And the market starts giving them a very, very high valuation. So the market says, let's not look at unit economics, let's look at price to sales, right? So sometimes the market tends to actually think that way. The outcome of this is the market ends up underweighting some of the niche players that are there in the market. So some of the wealth creators you have, they are not businesses that have a very, very large total addressable market. You have the sector or the total addressable market growing at 7%, 8%. This particular business is growing at, let's say, the expense of competition. So they take market share over a period of time. They move from 20% to 30%, 40%, and all of that. But then some of these businesses basically get underweighted. The market is just superficially thinking about the total addressable market size. So in some phases, the market values niches better rather than empire builders. Right now, empire building is being given its, I would say, deserved due. This wasn't the case till 2021. Previous cycle, people said all these guys are very, very capital inefficient. Okay, they're not good at capital allocation. So the market narrative once again keeps changing over there. One of the most important things, next point, businesses at various stages of the stock discovery, right? Are you holding stocks that all of them are emerging things? Or are you holding stocks where every single thing is already proven, right? Because if everything is, I mean, if every single stock that you hold is already proven, then it means there's a very good possibility that you will underperform in the alpha creation phases because re-rating scope is very, very limited for some businesses. I mean, for the proven businesses. And as you know, re-rating is obviously the holy grail of alpha generation and multi-bagger return. The best returns happen to you when a stock keeps growing its earnings at 20%, 25%. You're able to latch on to that when the valuation is in your favor. Let's say less than 15 PE, 10 PE, 12 PE. And then the business gets re-rated as well. So you make 4x from re-rating, you make like 10x from earnings growth over a 10-year period. That is when you end up with a 40 bagger or a 50 bagger. So many things need to fall into place. So look at your portfolio and ask yourself, the businesses that you're holding, are they just about coming into the limelight? Okay. Or have they come into the limelight and then have fallen off since then? Classical example being Laura's Labs. Okay. Laura's Labs got discovered in 2021, 2022. Since then, it has, I would say, fallen off its peak in terms of, let's say, the stock discovery cycle, because the earnings growth hasn't been all that great. But then the management continues to do a lot of interesting things, right? So that is a different category itself. And then you have a category like an Asian Paint, where you're saying the business is obviously fantastic, but it is right now under attack by a whole bunch of other guys. So it's coming off its peak in terms of popularity. So businesses in various stages of stock discovery. This is a very, very interesting, I would say, hat to wear when you're looking at your current portfolio. One of the underappreciated things is shareholding, right? So if you understand the IPO cycle in India, for the longest time, companies would directly hit the primary market because you didn't have alternative sources of capital for a business which wanted to grow. Today, the bulk of that value creation is being taken initially by either a VC firm or a PE firm, right? So eventually, when a company lists, you will see that it has already a lot of institutional ownership. And today, you have funds where a company that is pre-IPO needs bridge funding. You have so many pre-IPO funds that are capturing that market. And that market is clearly spiking in both in terms of volume and in terms of participation as well. So if you hold a business that has recently listed and you have a PE who's currently coming to the end of his, let's say, life cycle, at some point of time, block sales are going to happen, right? Block sales happen, you have more of selling force rather than buying force. Such stocks can underperform. So if you end up holding stocks where the shareholding pattern says that the largest investor or the largest shareholder right now has already exhausted all possible avenues to invest more into the stock, and his or her selling cycle is going to start, then you don't want to be overexposed to those particular things. And seen in typical TA terms, if you see a spike in retail shareholding, okay, post a very good run for the stock, it very often indicates, I would say, a distribution in technical terms, which means institutional shareholding starts reducing, the retail number of shareholders actually goes up. Generally, that tends to signify a short term or a medium term peak in the particular stock. So quickly moving on to the final two parameters before we get into the practical aspects of how do you put all of the GAN into use on a daily basis. Yeah. So final two perspectives that we want to cover as part of this session. So another very useful thing is ask yourself, is this a business driver or is this a business enabler? Right? What I'm saying is this. If you look at real estate as a sector, the driver is usually the real estate company. So a guy like a Brigade or a Prestige or a DLF, any of those guys who are the ones who are owning the customer, and they are the ones who are actually fulfilling the customer demand. And then you have the whole of the ecosystem. So you have HFCs, you have building materials, all of them are business enablers. So they supply to the person who's the primary business driver, right? So ask yourself, what is your natural, I would say, tendency? Do you like OEMs and system integrators? Or are you somebody who's naturally interested more in the ancillaries and the components of that? More importantly, you will have to understand and look for the industry structure where things are more and more consolidated. So if you look at some of the auto ancillary, I would say, industry sectors, you will hardly have 3 players, 4 players, but they don't really have pricing power. That's the challenge in the industry. Whereas when it comes to building materials, it's a long tail. You have a lot of unorganized players. So unorganized market is going to the organized market. So where do you really want to be? Do you want to be with a business driver or do you want to be with a business enabler? If you can find a business enabler who's really dominant in a particular sector, okay, somebody whose market share is really, really increasing, generally you're sitting on a winner, provided you don't pay a very, very high valuation. So ideally, understand the industry structure very well and ask yourself, where is your business sitting? Final point, yet another underappreciated point, the demand pattern for this particular business. Is this capacity creation based? or is this capacity utilization based? So just to give an example that makes this very, very clear, capacity creation would be auto OEM sales, right? Capacity utilization would be somebody who sells, let's say, tires or a battery or any auto component that has a very well-defined replacement cycle. So for an Amar Raja or let's say for a Seat, what ends up happening is I am not at the mercy of new capacity creation in the industry. I can go and monetize the existing replacement demand that is anyway going to come in at a particular defined frequency. So what are you looking at? Are you looking for capacity creation or are you looking for capacity utilization based? Now, capacity creation stories. Generally, capacity creation demand is very, very cyclical. And very, very cyclical means generally you have the presence of operating leverage and operating day leverage. It's usually order book driven. You will have 3 good years followed by, let's say, 3 or 4 bad years, things like that. Whereas capacity utilization based demand for a particular story, it is usually a bit more secular and it is more predictable within the same industry. So these are some of the parameters, I guess, which a retail investor can use in addition to using things like market capitalization and sector, and then putting all of this together. So a simple template that we were using about 4 or 5 years ago. So simple tabular column like this. Just make note of all the parameters which you believe are very important for your style of investing. Take every single business in your existing portfolio and make notes on this business on each of these parameters, right? Once you do this for your existing portfolio of 10, 15, 20 stocks or whatever it is, straight away you will understand which is the factor that you are most exposed to. You do this for your portfolio, you may realize that your portfolio is overweight cyclicals at this point of time. Okay. You're obviously overweight business drivers. You're possibly overweight capacity creation based demand. Then that tells you how do you need to complement your existing portfolio. And then when you evaluate incremental opportunities or fresh stocks, you need to run each of those ideas through this once again, this template, and ask yourself, does this really complement or add more flavors to the existing portfolio? Or am I just replicating what is there in the existing portfolio? That tells you whether you are truly diversified or not. And doing this consciously over a period of, let's say, 2 years, 3 years, gets you to a stage where you start doing things intuitively. But we did this consciously for about 2 years, 3 years, and I cannot put into words the amount of tremendous value that this exercise added to me personally. Right? The whole of my portfolio construct methodology today drives based on this very, very simple analysis where I've identified the parameters that I believe are most important to me, to my particular investment time frame, to my particular, I would say, customer segment that I'm really dealing with, and ask myself how well hedged I am. Am I really overweight, let's say, 2 to 3 factors? Or do I know? And then you can quantify the entire thing. You have the allocation for each business, right? The outcome of this exercise should be you should be able to say, okay, 70% of my portfolio is cyclical, 60% of my portfolio is focused on business drivers. And then you start thinking what the fragilities in your portfolio are. So I would suggest that you give it a try for a reasonable amount of time. My sense is this will add value to most people, and then you can start doing things a bit more. Yeah. So just to take a checkpoint on this, Prince, any queries on this so far? I'll be
Yeah,
very
yeah.
happy to answer.
So Kedar, when it comes to alpha generation, churning has to be there, right? And also churning has a cost to it. So how one should view this as a, I mean, the idea is like often people consider more churning with more cost, and the more the decisions, the likelihood of going wrong, right? So how we can view this churning, and this is what we have discussed so far. How you see that? How relevant is churning in that aspect?
Yeah. So I guess churning is a ground reality, which is something that we can't really move away from. Unless you are somebody who's saying, this is my static style, I'm investing really for the long term, 10 years, 15 years, I don't care about underperformance in the short term, which is a European example. So for most people, even when it comes to, let's say, the activity of churning. Now, putting it in the context of this particular session, so what happens is, now the starting point of diversification obviously is to ensure that you don't screw up much, right? Once you identify which are the factors that you're already overweight. Now, when you're already overweight certain factors, the decision you always have at hand is going to be this, and it's not an easy decision. Do you keep riding the themes that are already working very well, which are already valued accordingly, right? Or do you want to do forward thinking and start getting into themes where you think the environment is clearly getting better? I believe that churning has to be a function of this thought process rather than saying, a particular stock has already become 10%, 15% of my portfolio. So let me go and prune it. That is rules based, pruning and churning. But when it comes to, let's say, doing this entire exercise, that will straight away tell you that if I'm already overweight, let's say one or two factors. Number one, am I comfortable with the existing exposure or not? Right? If you are comfortable, then your incremental businesses, you don't want to latch onto the same theme again and again. Or if you believe that your exposure is already too high, and if you believe you don't have valuation comfort in your existing portfolio right now, that is where churning actually comes into picture. Then what you're doing is, I'm saying cables and wires have run up too much. I can understand businesses trading maybe up till 50p, 55p, but beyond a level, it doesn't make sense to me. I find myself worrying about, when the demand is actually going to come off, or when the stock starts to become really, really overvalued. You prune or you exit at that point of time. And then the incremental story that you put money into, it shouldn't be a replica of the stock that you're exiting. It has to ideally bring a slightly different flavor into the portfolio, which is going to manage the overall risk of the portfolio, right? So,
Right.
so churning prince is like this. So either you can churn to reduce risk in the existing portfolio, or you are saying you're doing it from an alpha generation point of view. I guess both of them get interlinked at some point of time, even if your starting point is different.
Perfect.
Okay, so moving on to probably, yeah, pretty much the last point I want to consider as part of this thing. So we have now spoken about diversification. I just want to run you through a real world example of top down thinking in a particular sector. So far we have spoken about, let's say, diversification after studying your existing portfolio and thinking in terms of how do I really want to, let's say, take incremental positions. Now, this is an example that we're taking from 2019. So this is from one of my posts on a value picker thread. I think the title of this, yeah, title is like right here, how to diversify in the pharma sector. So I'll just take you through the thought process of mine that was there at that point of time. So this is another useful tool that we use. When we try to research or let's say find opportunities in a particular sector, we go to a database like a screener or whatever else that we use. You just extract the entire peer set in a particular template. So the template can say what's the revenue, what's the PAT, what's the sales growth rate for the past 3 years. Okay, what's the debt to equity ratio? What has been the ROC? What is the ROE? Right? What is the market cap of the company? What is price to sales? You can come up with your own template and then just sit back, look at the entire Excel and start making basic notes about the entire sector. Right? Now, if you were to do this for the pharma sector, what we saw was that you have like what I think some more than 40 companies that were listed in India within pharma, right? Whereas if you try and pull out, let's say, the list for some of the other sectors, you will probably see maybe 10 or 15 companies that are listed. That's it. So within pharma, we saw that there were more than 20 companies that were trading at a market cap of more than 10,000 crores. Okay. All of them were profitable on an average. Yes. The average promoter holding was more than 55%. Right? Observation at that point of time was mid-sized companies were tracking better on capital efficiency than the larger ones. Right? The larger ones as well had grown sales at 10% even during the so-called dull period of pharma starting from 2015 till about 2019. Right? Now, more often than not, if you take aside that particular period, which was very, very, I would say, tumultuous for the pharma industry, more often than not, pharma as a bet has made money for investors. Okay. Now, if you look at, let's say, the gross average turns is around 2.5x. For specialized players who are very, very intensively involved in fair amount of R&D or specific molecules, it can sometimes go as low as 1x. But whenever that happens, you have higher margins to compensate for that. So, long story short, we will see that most businesses make an ROC of more than 20%, unless it's a totally different business model where you need to put upfront capital investments and then you need to monetize that over a period of time. So the notes that we had made over there, we said we prefer principles of elimination for the pharma sector rather than selection, because you have 40 stocks to choose from, right? You have a lot of choices, so you need to come up with your own style, right? And our further reasoning was that if you have a sector where the average business is profitable and is making more than 10% profit, it means management quality is not as relevant for that sector as some of the other sectors where the average player is losing money, right? So extended this logic, what we're saying is we see greater value in reducing risk rather than saying let me find the next guy who's going to come up with a blockbuster sort of a molecule, which is very, very rare in Indian sector, right? And for us to be able to actually figure out at a domain level, saying which is that business which is really, really differentiated, you need to have a lot of depth in pharma and in chemicals, right? You cannot be a superficial Excel sheet investor, look at the numbers, and then say, ki, yaar, what is the real value addition or what is the secret sauce of this particular company? So we figured out saying we don't have that sort of depth of analysis within this particular sector. So we said the possibility of making outsized returns given our skill sets is going to be fairly minimal. So then, what is the ideal mix if I want to take exposure to pharma and if I want to continue to be diversified and protect myself from some of the risks that are inherent in pharma? So the ideal mix would be bought. We said, let's buy one strong domestic market focused business that is not too expensive. So in 2019, I think Abbott was trading at a PE of 35. Business was growing at 12%, 13%. Earnings growing at 15%, 18%. It was an absolute no-brainer for us, right? So we went out and bought Abbott India. Then we said, let's focus on the API makers that are well positioned to benefit from the local manufacturing drive that is likely to see. So this China plus one narrative, there were already noises over there. It's just that COVID came in and completely took it to the next level. So we ended up buying one or two API makers. So we bought DVs. We ended up buying, I think, RT drugs at that point of time, right? Then we said within formulation, what sort of businesses do we really want to buy? We said we don't want to buy businesses that are facing a whole bunch of regulatory action right now from the developed markets, right? So we want to be in a rather soft regulatory environment, and we want to make sure that these businesses are able to commercialize whatever R&D efforts they're actually putting. So most businesses spend about 7%, 8% of revenue into R&D. The outcome of that is either a DMF filing or an ANDA. And once an ANDA gets filed, what is your track record on commercialization of the entire thing? Otherwise, the risk is you have a company that's doing a lot of research, but they are not able to succeed in terms of marketing the entire thing. Finally, we said we will look at a niche player only if we are able to do the work it takes to understand the business really well. But then we did an internal honest evaluation and we figured out saying we don't have those sort of skills and we don't really want to venture into it. Which brought us to the last thought process. What is it that I want to avoid? Right? We want to avoid businesses that have a history of US FDA observations where things could not be resolved in a timely manner. So if it's a business that has made heavy duty acquisitions in Europe, okay, it has gotten into too many things too soon without doing the appropriate due diligence. And then you're slapped with regulatory action. So over there, things take a long period of time to get resolved. So we said, let us avoid this points. We didn't want to invest into companies where there was a whole lot of promoter pledging, because on an average, if you're doing 20% ROC, if you're making 10% PAT, business growing at 15%, debt to equity ratio is usually under control. So we want to stay away from the outliers where the promoter is very, very aggressive and is trying to bite off much more than the management can actually chew off. So we said avoid capital raising, avoid M&A activity. Let's avoid those businesses that are tracking very low on the ROC parameter right now, because that tells me you have made a lot of investments in the past 5, 6 years that are yet to bear fruit. And we do not have the ability to be able to actually figure out what will work, what will not really work out. And then finally, we said, let's look at businesses that are not too expensive relative to the growth prospects. So we don't want to buy a business that's growing at 10%, where the investors are hoping that something will work out and something is trading at 40 PE. So this is just a practical example saying within a particular sector, how do you think top down? How do you figure out which pockets I really want to avoid, and how do you improve the resilience of the portfolio? So the ultimate outcome for us, I think, it was pretty good. Some of these businesses, one of them we continue to hold even today, but we were able to make 20-25% compounded from our pharma exposure steadily over the past 4 to 5 years. So yeah, this is the final example that we really want to talk of. So this is a top-down view, whereas the previous slides we said, how do you look at the existing portfolio, run through each business, understand the various factors that you are overweight in that particular business of yours, try to come up with an aggregate at the overall portfolio level, and then finally quantify and ask yourselves, how do I use those inputs to either prune positions or to take incremental positions into stocks that can give me a slightly distinct flavor compared to the overall portfolio. And the final outcome of this entire thinking should be something that says, okay, I am not exposing myself to a secular shock in the portfolio because I am aware of what are the factors and what are the trends that are currently working in my favor, so that either I can prune exposure or I can tell myself what is it that I really want to watch for. Yeah, so basically that concludes the content that I wanted to sort of run through this. Over to you.
Great, Kedar. So, Kedar, one question I had asked you previously as well, but for the benefit of our audience, maybe potential people who can connect with us in future as well. So, there is always a gap in the sense कि एक अच्छी advisory को आप अच्छे रूप में you can utilize those services in a better manner if say n number of people are subscribed to one person, right?
Mhm.
Their returns would be totally dependent on their behavior or how they execute things. I think you agree on that. So
Absolutely.
materially what I want to drive the point is how we should go about it. Say if I have taken your services from today, what
Mhm.
should be my expectations, how should I react, and there are certain moving points in the sense like ticket size, conversation or communication which can you say. And in advisory, although in money management there could be some hand holding that you are doing on behalf of your clients, but in advisory the onus of investing or not investing is totally up to the subscriber, right? So that aspect also I would want you to cover.
Yeah, absolutely, absolutely. So over here, we believe that the bulk of the due diligence should happen over a period of time and before you decide to actually shortlist a particular. So my suggestion would be, ask yourself if this advisor has enough content in the web domain for you to be able to evaluate this particular, I would say, service, and ask yourself, how do they see the world? How do they actually go about doing things? So we believe at least the better advisors in the market, they have taken special pains to ensure that they are putting things out there in the market, right? Ideally, you should evaluate people, track people for about 6 months, 12 months, understand their performance, understand their investment philosophy, understand their thought process, and then you decide who exactly do you want to consider signing up for, right? If you are completely convinced, go ahead. In certain cases, you can even request for, let's say, a short interaction with the owner of the advisory service or the fund manager, and just understand how does this person think, number one. Number two, how open are they to sort of explain their thought process? Some people may not be very open because they believe they don't want to really do too much of one-on-one communication, right? So so you'll have to kind of evaluate that if you are going to be really comfortable with that. Okay, so once you do all of these things, and once you, I would say, speak to somebody over the phone, leave alone meeting somebody in person or doing a Zoom call, you will generally tend to evaluate the person as well, which is why we investors do management meetings, right? So just as investors do management meetings, we believe that even people who want to sign up with a long-term advisor, you should do a fair amount of evaluation and ask yourself, what is this person really motivated by? Is this person motivated only by scale, right? or easy motivated by, other things in life in terms of I want to do the right thing, I want to sign up the right kind of customers, right? So those things are ideally you should see it in place if you're looking to have a long-term partnership with somebody, right? But at the same time, if your only objective from an advisory is you want access to, let's say, research notes, you want to have as wide a pool of new opportunities as possible, then in that case, you can take a slightly different approach. But once you sign up to an advisory, you need to be clear. Why have you signed up? Are you signing up because you like their idea generation? Okay. In which case, the advisor probably generates 6 or 7 ideas in every year. You may not want to execute all of them in the portfolio. You will look at your existing portfolio. You may, let's say, use your own filters and figure out what is it that you want. That's a totally different approach. Or are you looking to say, okay, this is somebody who's aligned with me. I can completely relate to whatever this advisor is saying. I just want to replicate everything that this person says and then give it a try for, let's say, 3 years, 4 years, and see if I can execute things well, right? So that's the second approach you can take. Whichever of these approaches you take, my suggestion is this: do your due diligence before you sign up. At no point of time do you want to sign up rather quickly and then start, second guessing, saying, okay, is this the right thing? Should I be doing this? Should I be not doing this? Be very, very clear. Be very, very clear about that. And once you sign up, give somebody something like maybe 2 years, 3 years to understand their style. Sometimes you can understand the style, but some people do not take the effort of communicating with their subscribers all that well. Some people do video meetings. We put out a lot of content. We put out a monthly newsletter. We send regular updates to our customers. We write sector summaries on a very quarterly basis. And our subscribers who run through that, they know exactly why we are taking the decisions that we're actually taking, which means that is where you derive the sense of conviction. Whatever you do, once you signed up, you need to commit to that sort of action for the next 2 to 3 years, and then you need to execute in a timely manner. If you cannot execute, if you're too busy with your day job, and if your job doesn't give you such luxury to be able to do that, the best thing is to just go into a mutual fund, maybe go into a small case where the incentive structure is aligned to you, maybe go into a PMS or whatever it is. If you want to do things yourself, so you need to be able to commit that sort of time, commit that sort of energy, and evaluate people over a period of time. And we would also suggest saying don't start off by giving a high allocation to someone. What we say is generally if you are onboarding a customer who intends to have, let's say, 100 rupees in equity as an asset class, generally you will have 30 rupees, 40 rupees either going into index funds or large cap mutual funds or whatever it is. Then you should ideally have maybe 2, 3 advisors you are working with who will contribute the remaining this thing so that you don't have more than 20-25% weightage on one single strategy. And then over a period of time, you can figure out where you really want to concentrate. So these are some of the tips I believe that people should be doing, which ideally doesn't happen in all the case. Otherwise, what happens is now, see, as an advisor, people are very happy to take your money. Right? The worst scenario is where, I mean, this is something that really I am not comfortable with. I don't want a situation where somebody is signing in, right, and then doesn't use it. And we see some people don't even log into with the content that we really post. So yeah, this it calls for some amount of commitment from the subscriber as well. Please be clear about all of these factors before you sign up with anyone. That would be my sincere suggestion to anybody who signs.
Perfect. And I agree on that part. I mean, subscribers are basically for names only. Some are more concerned about what the thought process of the person is. They want to understand that more so as to build their own conviction. And you rightly said. And no psychophancy. Obviously, I do a channel check within my circle, and honestly blessed with a very good network. And people have very good and positive views about your services, those who are using it. And I appreciate on the client communication aspect as well, Kedar. So kudos to you for that. And I sincerely hope more people will be able to relate with the thought process so as to learn and associate in a positive manner to build their own conviction and investing. So thank you so much, Kedar, for taking out time. It was a lovely session, and I sincerely believe that our audience will totally relate to that and improvise on their investing style. And in case they have any questions, they can always reach out to Kedar. The details of his website, Twitter, and even email ID is mentioned in this presentation. And I'll be sharing these links in the description of this video. So definitely you can, and then as rightly said by Kedar, just in case you guys want to associate, you can always write for a short call or a chatter wherein you can understand the thought process better. And if that aligns, so definitely you can look up to the services. So thank you so much, Kedar.
Thank you, Prince. Great being on your platform as usual. And thanks to everyone who signed in to actually hear us out. Hopefully, you will have some tangible takeaways from this and you'll start implementing some of this in a structured manner over the next 3 to 6 months. So, thank you, everyone. Thank you for your time.
100%. And look forward to the feedback. You can always write on the details mentioned or in the comments so that if there are any questions, I can reach out to Kedar or you can directly communicate over email ID. So he'll be happy to address your questions as well. Thank you so much. Take care.